This is the basis of technical analysis, but you don't need to do anything too fancy. In fact, you really only need to look at the direction that the market as a whole is moving to determine what about 80% of stocks are going to do at a given time. If the trend is going up, stocks will likely go up. If it's down, you'll want to wait for the line to stop going down if you're looking to buy again with less risk of a decline. When the financial crisis ended in 2009, stocks had an immediate and powerful rally that eventually petered out. Over the past few years, the markets have been in a pattern where they've tended to trade sideways, fall around 10% or so, and then rally to break new highs. A sideways trend is no big deal. It means you can likely find individual bargains in the market and, for many positions, you can simply wait for a new trend to emerge and collect dividends in the meantime. An extreme upward trend, one with a 45-degree angle or higher over 6 months, is usually a sign of a bubble forming. Stocks got extremely bullish and briefly exhibited this in 1929 and again in 2000. Many individual stocks can do this all the time, too, when they hit a faddish peak. The cryptocurrency Bitcoin made this move in early 2017 before tumbling back down. It's the only bullish trend that's likely a good reason for you to be bearish. Number 2. What non-market participants are doing. I'd like to think that the market is really all that matters, but it isn't. A variety of non-market factors can influence the market as well. That includes political events like elections in the United States and other Western nations. Surprise outcomes like Britain voting to leave the European Union in June or Donald Trump's presidential win in 2016 can sometimes cause shock as folks make quick decisions about how to better invest in light of these new events. The biggest factor by far is the Federal Reserve. Whole volumes have been written about it, and I've written extensively about its failure to stem off the financial crisis in my previous book, Uncharted, Your Guide to Investing in the Age of Uncertainty. What matters right now is that the Fed has kept interest rates near zero since the financial crisis. They raised the prime interest rate, the rate most talked about and the one they charge to banks, from 0% to 0.25% in December 2015. When they did, markets had a 6-week tantrum that led to a 10% decline in stocks before things turned around. Why is such a small move such a big deal? Think about it this way. When bonds yield 5%, a bond with an annual payment or coupon of $5 trades at $100. When investors demand higher yields and move rates to 10%, that bond will need to trade at $50 for the $5 coupon to meet the new going rate of 10%. In that example, the price had to fall by half. If you're a bond investor, right now, with interest rates so low and the Fed moving toward raising them, things look dangerous. But the alternative is to keep rates near zero, which also means ultra-low interest rates on mortgages, car loans, and stock trades on margin. These low interest rates run the risk of overfueling the economy now, leading to a worse recession later. Besides that danger, low interest rates mean bond yields are low, whether they're government, corporate, municipal, or junk bonds. Investors looking for yield aren't getting it from money market accounts or their checking or savings accounts either. Just think, 10 years ago, a savings account might yield 4 to 5%. Today, most yield less than 1%. That's a 75 to 80% loss of income from a safe place to secure your money. That's pushed investors into stocks like utilities and telecoms. These highly regulated industries provide the most bond-like returns on the stock market. They're now becoming much more sensitive to interest rates as long as the current low-rate regime continues. Number 3. What the underlying company is doing. Knowing what you're investing in matters. At the end of the day, a share of stock is one small fraction of an underlying business. Your best results as an investor will come from treating your investment decisions as though you were buying not just a share of stock, but the entire company. That's where fundamental analysis and valuation comes in. It's important to know what a company does, how they do it, and whether shares are cheap or expensive compared to their industry. It means